All around the world, the central banks are starting to breathe a sign of relief. In the US and Europe, the big conversation is about when to cut interest rates and pump some new energy into their economies. But here in Canada, the door has been slammed shut. The Bank of Canada is holding firm. It's refusing to join the global party, a decision that is crushing Canadian families who are already feeling the squeeze from the high cost. This isn't the story of a booming economy that can afford to wait. This is a story of a central bank that seems determined to make the Canadians poorer. While the big banks posted record profits, and the reason for this lonely, difficult position isn't some complex economic puzzle. It's a deliberate choice. A choice that ignores the pain of millions in favor of a flawed strategy, raising serious questions about whose interests Bank of Canada Governor Tiff Macklem is truly serving. On January 28, 2026, the Bank of Canada made its announcement. The key interest rate would stay put at 2.25%. On the surface, Tiff Macklem tried to paint a picture of stability, if not outright strength. The bank's official story is that this is working. They point to a phony forecast of economic growth and feels like a recession to anyone that is not in a corporate boardroom. They highlight inflation numbers that are slowly moving in the right direction. While the main consumer price index, or CPI, ticked up to 2.4% in December. The bank's preferred core inflation measures have eased, landing around 2.5%. This is a carefully chosen words of the central bank. Since inflation is getting closer to the 2% target, the current interest rate is appropriate. But this official story is an insult to the intelligence of everyday Canadians. Macklem talks about navigating uncertainty, but the only thing that this is certain is that this policy is brutal. The real story here isn't about modest growth or core inflation. It's about a policy that seems designed to protect Bay Street profits at the expense of Main Street survival. To get why Tiff Macklem's hands aren't tied, but are actively making things worse, we need to talk about the real threats facing Canadians' economy. The threat of U.S. protectionism, ongoing tariffs, and the oncoming review of the U.S.-Mexico-Canada trade deal are not hypothetical. They are very real. These are major risks from our export-driven economy, which fell by 6% in the face of serious external threats. You would think the number one priority would be to strengthen our domestic economy, to make it more resilient and enough to handle the shocks. But the Bank of Canada is doing the exact opposite. Its high interest rate policy is weakening us from within, creating a movement that is squeezing everyday people. Imagine you are trying to run a business. You are facing the risk of new tariffs and trade instability. So you are already hesitant to expand. On top of that, your borrowing costs are sky high because of your own central bank. Now imagine you are a family with a mortgage. You aren't just imagining it, you are living it. You are cutting back on everything just to make your payments, all while worrying about unstable economy. And for what? So that the bank that holds your mortgage can announce another quarter of record earnings? This is exactly what's happening. And it's a direct result of the self-inflicted wound during a trade war. This toxic policy has put Canadian families and businesses in an impossible situation. For the Bank of Canada, this isn't a bend, it's a deliberate choice. Normally, when an economy slows down and faces external risks, a central bank cuts interest rate. It's basic economics. Cheaper loans encourage businesses to invest and people to spend money, building a domestic cushion against international turmoil. But Tiff Macklem is refusing to do the obvious. The bank has said the rate cuts aren't solving problems like the trade uncertainty. While that's technically true, it completely misses the point. A rate cut isn't meant to end a trade war. It's meant to give the Canadian businesses and families the financial breathing room to survive one. A rate cut would obviously solve the biggest problem Canadians have right now, their inability to pay their bills. So why not at least help out the family struggling with the debt? Their excuse is inflation. While inflation is trending down, it's still at 2.4%, stubbornly above the bank's 2% target. They are using this minor overshoot as a justification to inflict major pain. Cutting rates now, they argue, would be a gamble. But the real gamble is in their current policy, which is betting on your financial security against the interests of the banking sector, right when we need to be at our strongest. This high-level decision at the Bank of Canada is a direct attack on your wallet. First, the bad news is obvious. For millions of Canadians with variable rate mortgages or line of credit, relief is not on the way. The financial pressure, that squeeze that you feel on your monthly budget, is going to continue feeding directly into the record profits of the big banks. This is happening when the Canadian households are already stretched thin to the breaking point. People are spending more than they are making, which means they are either draining their savings or taking on more debt just to keep up. For the middle income families, the saving rate has been completely decimated. So while the bank calls this rate hold strategically necessary, it keeps the pressure directly on your family budget. Second, this is all connected to the job market. Why would a company hire or expand facing both trade uncertainty abroad and central bank that is actively trying to slow the economy here at home? The recent rise in the national unemployment rate to 6.5% is a direct symptom of this policy, which I think it's higher. It's double whammy created by the banks. The cost of living stays painfully high, while your chances of finding a new job, better paying job, gets worse. So Canada is walking a lonely economic path, while other countries are preparing to help their citizens. The Bank of Canada is choosing to stand perfectly still, leaving you to bear the cost. Let's be clear, Tiff Macklem isn't holding rates steady because our economy is strong. He is prioritizing a flawed inflation target over the well-being of the population, even in the face of serious trade threats. This isn't a painful choice he was forced into. It's a policy that actively helps banks and hurt the regular people. Faced with a problem he could easily alleviate, he has instead decided to inflict the pain, leaving Canadian families and businesses to absorb the blow. So, what could break this stalemate? Really, two things. First, a sudden realization from the banks that this policy are destroying the country from the inside out. The second possibility is a much sharper downturn here at home, a recession so deep that the bank is forced to admit its mistake and cut rates, finally putting the needs of the citizens ahead of the banks. All eyes will now be on the bank's next announcement on March 18th. Only a few are holding their breath for a change, and I don't think it will happen. What do you think the Bank of Canada should do? Is inflicting this pain the right move for stability? Or are they just protecting the banks at your expense? Let me know your thoughts in the comments below. If you have found this information helpful, please make sure to subscribe and hit that notification bell. I'm a real estate broker right here in the GTA. If you are thinking of buying or selling real estate, please give me a call. My information is in the description below. Until next time, see you soon.